Good morning or good afternoon, depending on which part of the world you are. My name is Victor Murinde. I'm AXA Professor in Global Finance and also the Director of the Center for Global Finance. And also to announce Executive Director very soon of the African Economic Research Consortium. Today we have a very, very interesting seminar in the area of risk management. And we have our very own Dr. Jaideep Oberoi to share with us some of his work. And it is in order to introduce Jaideep, although I'm very sure and certain that almost all of us in this seminar know with him, interact with him as a colleague, or have met him or his work in the last couple of years. Jaideep is a very active, productive researcher whose research interests are in the field of risk management and variations of risk management, working around with the all types of models that involve risk, looking at, for example, idiosyncratic risk. And part of the announcement of the title in this was on idiosyncratic risk. He is taking another step beyond that to share with us also some of his other work that has been in progress in the spirit in which these research seminars are carried out. That is, to share preliminary work with colleagues, to be able then to get comments and feedback into the work, with the ultimate aim that the quality of the work, ongoing paper would be enhanced, and it can increase. That would increase the chances, the likelihood of being accepted in the journal, and reduce minimally the chances of getting a desk rejection. It is in that spirit that Jaideep is presenting this paper here. Further back on Jaideep, his publications have covered a range of topics, including corporate risk management, market microstructure risk estimation, modeling of long-term risk in pension assets, and also covering actually other risks such as demographic change, weather risk, risk due to governance, performance, and of course, asset return modeling in general. And he has also been very successful in generating research funds and working with the industry as part of partnership of research between researchers and the industry or practice. And so, Jaideep, we welcome you very much today to share with us your work. Please go ahead and start your presentation. Thank you.
Thank you, Victor. And to everyone also, so apologies for the change of paper title and paper presentation, basically. So I thought this would be more appropriate today. So the paper I'm going to present is called Horizon-Specific Information and Option-Implied Correlation. And it's joint work with Nikos Voukelatos, who's my former colleague at Kent Business School, and our PhD student, Xiaohang San. So Xiaohang has just graduated, and he's got a job now with State Street in their research division. So just to tell you a little bit about what this paper is about, the key sort of object that we want to think about the forecast is the equity premium. And so many of you must be familiar with this picture. You see it all the time. A lot of my friends used to joke when we were PhD students that, you've got these 100 years of this equity return data, the market return, and we spend a lot of time trying to understand, how you could possibly predict that and why it is what it is. So this is the quantity that we really want to go after. And of course, we can also see, firstly, that it is not constant, and so it does change significantly, and it has some. It's difficult to argue that it has any kind of pattern as such. So there's been over time a bigger and bigger interest in trying to predict the equity premium. And so when we think about forecasting the equity premium, there's a fundamental sort of question about market efficiency and things like that. So I'll come to that in a moment. But we can also think of that as being a way to understand expected returns. So it's a pretty honorable objective. Let's put it that way. So a whole bunch of early studies tried to say try to show that the actual market return was somewhat predictable, and the way they approached that was to think about looking at it in different horizons, looking at it using some fundamental theories. So, for example, it's by design that you would expect that the dividend yield would predict future returns just by the mechanics of what we teach in our initial corporate finance classes. The same with the price to earnings ratio or the market to book ratio. Uh, so these are uh, sort of course, these are aggregate versions of individual corporations, but in the end, they come from kind of a mechanical relationship from the way we think about valuing a firm or valuing stocks in general. And then there was the kind of the economic theories that were based on sort of risk factors that are more long term or that have a more economic foundation in them. And so things like the term spread or the spread between long term and short term bonds, which tells you something about economic conditions, or default spreads, which was the spread between risky bonds and the riskless bonds. So there's a whole bunch of very sort of illustrious work on this topic that was done from the 80s onwards, trying to work out what exactly predicts the equity premium, and of course justifying why it should be predicted in the way that it is. Then along came Goyal and Welch in 2008, and they basically showed that most of these findings are really unreliable, unfortunately. So basically, the equity premium's predictability is quite unstable. It's quite poor. All the theories they don't sort of stand up to significant scrutiny when you look at a lot of data, or if you try to create portfolios to invest based on the predictability suggested there. And so other people then also publish similar findings, uh, where we have now a kind of a question about how do we predict what predicts the equity premium. In parallel, there's a whole bunch of literature from the asset pricing side that's coming out, which says uh, we should be able to predict it better if we understand the factors better. So people started to come up with alternative ways of doing it. So the first set of ways of doing it was to use other predictors. So people came up with, as more data became available, they tried different alternatives. There were technical indicators, which essentially uh, talk about behavior, essentially in the markets. The investor sentiment type variables, which again talk about behavior, but in a slightly different sense because they translate into news about uh, discount rates. So, what people sentiment affects discount rates, and that's why maybe it has some kind of predictive power. Then the whole idea of cross-section return dispersion again talks about uh, either about the information environment or about correlations in the market. So there's different ways in which you could link that or the predictability of individual cross stocks in the cross section. All of these factors could potentially predict the equity premium. Then other variables people tried to show which work include things like oil prices, which are fundamental to the economy, news, uh, and also managerial sentiment. But uh, getting into the more technical variables, there were things like the cross-sectional higher moments, which basically talk about the skewness and kurtosis of the cross-sectional distribution of stocks. So we go from cross-sectional return dispersion to cross-sectional return skewness. And again, there have been some results showing some improvement in equity premium predictability. So what I'm trying to say is that despite the setbacks, the predictability sort of train marches on, and we get more and more results where people do show sort of marginal improvements with each step. So apart from the alternative predictors approach, there's also another approach, which is to use the econometric methods to choose something slightly different, which is, for example, start just getting better at using sort of basic econometric techniques like forecast combinations. Uh, just using everything that you have, dimension reduction as well in the process, which probably makes your forecast better. And then applying methods such as quantile regressions also uh, to the prediction makes sense, partly because it captures some of the information that's in the predictors. For example, the higher moment information or the return dispersion information. It's another way of capturing this type of information. So uh, this is a very active, as you can see, and very a lively field where people are still trying to improve the equity premium, but it's a challenge, and so we still have a long way to go. A lot more suggestions keep coming up. One, of course, the natural suggestion that comes up is to look at forward-looking information from market sources. So we try to imply a lot of forward-looking information from market sources from the beginning, like going back to the time when we talked about the term spread. But we have market prices about the distribution of returns uh, uh, from options. So, of course, we should be using option implied information to try and improve the predictability of the market return or the risk premium. So, people started with things like the implied tail risk. Now, that's suggesting that if the option market is sort of pricing very extreme outcomes, then the market risk premium should be higher. Or the volatility spread, which is also known or a variant of that is the variance risk premium, which a lot of us understand and work with in different contexts while trying to predict things in the markets, and even using benchmark strategies. So essentially trying to set up option return strategies uh, based on the market, and then using that for prediction, because that's basically the effectively the implied market based forecast for the equity premium. And then the one that I'm going to talk about today, which is implied correlation. So uh, option implied correlation is essentially something that connects a bunch of these ideas. from the traditional asset pricing side of things to forward-looking information and information about the risk aversion, for example. And so that's why it's such an appealing variable to use. So before I go forward, uh, maybe I should just put in context the idea that uh, so where this kind of correlation, implied correlation, comes from. Uh, Initially, we probably one of the first people to think about it was I think it was Merton. Sorry, not Merton. Anyway, my Rubenstein, when after the 1987 crash, when we talked about the sudden increase in the implied skewness of the risk neutral distribution. So there's kind of a history of thinking about correlations implied as well, yeah, that we already have. Now, what we have so far, what's coming out in the recent literature, like in the last 5 to 10 years, is that implied correlation extracted from option prices can predict market returns for horizons of up to 1 year. Now, that's pretty a major improvement. Essentially, we know the the equity premium maybe in the long range, going back to Campbell and Schiller and so on, it's a bit more predictable actually over a longer horizon. But in the short horizon, it's a bit challenging to predict. And so that's why this kind of variable, if we can extract some information, is really valuable to us. Now, what's interesting about it is that the implied information from the option prices is incremental to realized correlation that we've already, that we could just calculate directly from stocks. It's also incremental to other option implied variables. So a bunch of people have shown this. They've looked at different option implied variables, including the variance risk premium and so on, and they've shown that traditionally people use the VIX, for example, to as the first sort of option implied variable. They all of these do not. None of them subsumes the information that the implied correlation offers to add in the predictive power in terms of market risk premium. So maybe at this point, I'll just stop quickly if there are any questions or if.
So far, so good, Jaideep. I don't see any in the chat or any hands up, and I encourage colleagues to intervene as we go, so you can be interactive. But for the moment, please go ahead.
Thanks, Victor. So because I couldn't see the chat, so I just wanted
to check. I'll have a look. I'll keep a look on it.
Thanks. Yeah. So why exactly is implied correlation something that should matter for the risk premium? It's the kind of probably the first question we should ask, because we don't want to go down a route of just sort of this data mining or something like that. But so there's a whole bunch of mechanisms that people have sort of proposed for why implied correlation should matter. I mean, correlation itself, for instance, does give us some information about investors' disagreement about the future state of the market. So basically, we've got heterogeneous beliefs, and that has there's a lot of theory about why that would lead to differences in the total risk, sort of the price of risk that people are willing to bear in aggregate in the market. But also, when we think about correlation, it talks about it is the counterpart, effectively, of the part that's not explained in a sense. So the idiosyncratic element of the risk in the stocks. And so by itself, it comes close to capturing features like the R squared or the non-diversifiable risk in the market. And so by design, it should be mechanically something that would uh, be compensated in a sense. What's interesting about correlation is, of course, because it's time varying. Uh, Something that makes it a little bit more sort of potent is the fact that its time variation is somewhat predictable in the sense that it's negatively correlated with returns. So, so in a sense, because it's a sort of a state variable, and it matches with the financial risks, and it has also some relations with the macroeconomic states of the market. You have a situation where, for example, uh, uh, correlations go down in really good times, and go up in really bad times. Uh, so you can think of that as being something that is a proxy for what we want to price. And because we are thinking about something that's priced, we are thinking about it being able to forecast returns, of course. And so the uh, the idea behind implied correlation in particular is really valuable, because again, we're now looking at forward looking information about the future correlations. So, coming back to that observation I made about the implied, so the risk neutral distribution implied by options, when you look at the risk neutral distribution of the stock market of the S&P 500 options, for example, you see a kind of a big skewed left tail. And the idea behind where that comes from was originally people talked about, of course, the leverage effect. Uh, is is one of the sort of the theories that's been out there for a while is that the left tail is fatter because correlations go up in bad times, and so that's why or rather the risk. So the people are, or that's the higher weight that's assigned by the option sellers, let's say, to that state of the world. That's basically causing this kind of so it's almost like reflecting a picture of what the premium should be. And so that's why even sort of the increase in the implied correlation is directly linked to actual market volatility. And by sort of a mechanical process, you could argue that that leads to changes in market returns as well. So apart from the sort of the underlying theoretical reasons, we also have the uh, sort of kind of another sort of, let's say, just calculation based reason for thinking that implied correlations will be good at forecasting uh, the market risk premium. But even IC I'm going to call it IC now, is for implied correlation, is not amazing. So even the IC's performance is kind of horizon specific, in the sense it's better at more than 3 month horizons. So if you're trying to forecast the market risk premium in the first 3 months from today, it's really very, very difficult to do, even using implied correlation. So people have tried to look for the information content in this implied correlation. So they've done it by, for example, decomposing it into variance, idiosyncratic variance, and dispersion. They've also tried to decompose it into different kinds of risk premia. So by breaking it down into the continuous and the co-jump components of the correlations, because you basically the idea is that the really extreme left tail comes from the co-jumps. Uh, all of these ways of breaking it down have still not essentially uh, given us better understanding of why the short-term forecasts uh, are not working really well. So or we're not good at forecasting so far, or there's not enough information. So this is where this paper comes in. So what we want to do is to say, okay, hang on a second. Is it the case that because we are looking at options, and options are basically priced by horizon, so by definition, you have like weekly, monthly, uh, 3 months, 6 months, 9 months, 12 months, 2 years, 5 years options. So uh, each of these option each of these options has kind of specific information priced in it, and you could, for example, initially think, okay, like, why don't I just kind of mechanically look for information from one set of options for one particular horizon and use that for pricing, or for forecasting. So that's one route available to you. And then there's the other route which we've taken, which is, rather than uh, try and uh, extract information from potentially illiquid or sort of not so frequently traded options and so on, why not use sort of, let's say, an econometric technique instead? Look at implied correlations, which does incorporate information from all these options, and then standardizes it. Uh, but look at it as a time series itself, the variable implied correlation, and decompose it into its some frequency components. Is there any information in the time series of implied correlation that we can use from the frequency domain, essentially? And so that's our sort of idea, and that's why this. I mean, I've given you a lot of background, but fundamentally, it's a relatively simple paper where we are trying to understand if there is still some information, some juice that we can extract from implied correlation, and also to understand what where the information is in implied correlation in the time in the frequency domain. And so we break it down into two components: a high frequency component and a low frequency component. And they have very, very different properties, naturally, by design, in a sense, from the original implied correlation. Uh, Incidentally, the implied correlation is a straightforward thing. It's actually calculated and published, so anyone can download it. It's a pretty straightforward series. I'll explain how it's calculated in a second. And what we find is that, indeed, high frequency the high frequency component of implied correlation does capture short-term fluctuations, whereas the low frequency component captures longer-term trends. So while implied correlation itself is an efficient predictor of the market risk premium, ICH and ICL improve on it. So we take the same variable and we can use it to improve on the forecasts. So IC itself has a lot of horizon specific information, basically. And so that means that because we can break it down, we can see that when we use ICH instead of IC, we are better at predicting short-term horizons. And when we use ICL, we are better at predicting long-term returns. And so what's really important to know is that if we use the original IC series, we will not be able to achieve the same outcomes. So what have we done in terms of the data? We've got about 25 years of data, basically on the implied correlation, which Dreesen et al. They actually publish it, can be downloaded, and so we take this IC, and you could of course extract it for different maturities, as I mentioned: 30, 90, 180, and 360 days. And then how IC is calculated, sorry, before I go forward, it's you can see that the formula is simply the only thing that I need to explain here is IND stands for the index. So effectively, this is an implied version, and so we use the options on the index and options on the individual stocks that are part of the index. The W stands for the weight of the individual stock. And so effectively, this is a kind of an average of pairwise correlations of the index constituents. So it has a kind of a real world counterpart, but this is from the implied data. And so the important thing to note from this is that we can do this for different horizons, so expected from T until the option's maturity. And also we can do this, we are doing this under the risk neutral measure. So this is risk neutral correlations. They're not the same as the real world correlations. And that's basically where we think the information is, because the risk neutral measure is giving us some idea about the risk aversion and so on, about in terms of the market participants. And so this is what the series looks like. And you can see that it actually isn't that far from the realized correlation, which is in dashes, but it's more smooth, a little bit smoother than the realized correlation. There are times when it's higher than the realized correlation. There are very few times when it's slightly lower than the realized correlation as well.
Okay, so this is based on a data data
yes.
price, the frequency. The highest frequency is okay, on data.
Yes.
Okay.
And so this is what the correlation sort of looks like. So you're looking at the different horizons. So you're looking at the 30-day, 90-day, and 180-day implied correlation and realized correlation, and the difference between them. So you can think of the IC minus RC as the correlation risk premium, just the same way we think of the IV minus RV as the variance risk premium. So of course, we want to check this for sure, because if we got this wrong, if this was negative, then there'll be a problem with our data. So this is just a confirmation that the data is correct. So we can see that there is the standard correlation risk premium present in the data. We can also see that there's a kind of a term premium, because IC increases with the maturity. So it goes, for example, from 0.37 to 0.42, then 0.44. So that's the implied correlation. Now, what do we do to it? So there's a technique called empirical mode decomposition, which was Xiao Hang's baby. He was like super keen on using this particular method for decomposing doing the frequency domain decomposition, partly because not a lot of people in finance or I think almost no one in finance has used it yet. And it's from sort of the engineering literature. And, because it doesn't really matter that much, it shouldn't matter that much what method you use. We decided to encourage him to follow his interest in a sense. And so that's the idea is basically the same. You go into the frequency domain and you break down the data. So I'll show you a couple of steps that are involved in this, right? So you create some kind of oscillatory functions. They're called intrinsic mode functions, and then you keep extracting these intrinsic mode functions from the data, and the idea is that you need to converge to something. So you converge when there's basically not a lot left for in the variation. So you start with the highest frequency and you keep going down until as the frequency sort of keep increasing the frequency as you go along. So the main idea is that the original time series is essentially just the sum of the these individual intrinsic mode functions plus a residual term. So the sifting procedure, I've just put it up here, but essentially, like I said, you set it initially uh, uh, with the highest frequency, and then you start to you fit a cubic spline. You then you sort of you've got the first intrinsic mode function. Then check if there's more that you need to. There are enough extreme values essentially in the data, and then you keep trying to reduce that until you get to a stopping point. So in our case, so this is what these look like. Okay, so this is the highest frequency stuff, and then you've got the medium, and then the really low frequency. And so you can see that you've got like 9 components basically. And so the final one, this R is the residual. Okay, so when you look at these 9 components, you add them up, you get implied correlation back again. So plus this, of course. So if you think about the variation, you can see that we've extracted some amount of like sort of longer term movement here, and so we can break this down so that we combine uh, the the sh- the really low frequency parts uh, into one component. We add them up together, and the high frequency parts we add them up together, and we get basically 2 components, ICH and ICL. And again, if you add these up together, you'll get the original series again. So what we do next is, of course, to actually now check the results. And so the first thing is to run a regression of the implied correlation against its own components, ICH and ICL. And of course, ICL and ICH should explain IC. But when you look at the different horizons of the implied correlation, you can see that basically there's no sort of problem with explaining IC. Between the two of them, ICL and ICH are pretty significant. They explain the underlying series quite well. So we can obviously, as we would expect, ICH explains most of the variance in IC, and the ICL less so. Now, what we then do is to try and see whether the implied correlation has any predictive power for the actual realized correlation. So that normally, is the case. But what about ICH and ICL? So when we regress the realized correlations on IC, IC does improve the forecastability of the realized correlation. So there is some forecasting power in the implied correlations for future realized correlations. Now, that over and above, of course, lag values of the realized correlation itself. Now, what happens though is that as we go further out into the horizon, implied correlation is not as good at forecasting the realized correlation, which again is not particularly surprising. We see that in variance data forecasting models and all the option implied kind of findings anyway. And so it just kind of carries over that all of this is what we expect really. And then we find here though, that the realized correlation is better predicted by the low frequency component than the high frequency component, because when it comes to predicting the realized correlation, not the implied correlation itself, it's the low frequency component that has some kind of like low noise, and so therefore a better performance. And so here's the table of those results. And you can see that just using RC on it, regressing it on its past values, you get 21% adjusted R squared. But when you include IC, even without RC, you get a 32% R squared. IC stays significant when you bring RC back in. And then when you add the two alternative components, it's the low frequency component of implied correlation that has the most impact in terms of improving the R squared. Even at the 30-day horizon, and then the 90-day data has the same pattern. So there's not much difference. And then this is just more for the 180-day horizon. And here too, you see, although predictability overall, as you can see, up to 90 days, it's pretty good. When we get to 6 months, it starts to look a little bit weaker, but everything is weaker. And still, there is some extra power in ICL compared to the others in forecasting realized correlation. And so the next thing we want to get to, the main thing is the main show is the market risk premium. So what we can do is, of course, do the traditional exercise of just trying to regress the S&P 500 returns on lagged values of the correlation risk premium, market risk, implied correlation, implied variance. This is the model-free implied variance, and the variance risk premium, ICH, ICL. So all of these are option implied variables, basically. And we're just throwing them all in there to see what we can get. Are there any improvements? Now, because these are overlapping regressions, what we're doing is essentially we are compounding over multi-day horizon. So we have to use the correct standard errors, and we take care of all that. We just follow what Dreesen et al. Did as well. And so here's what we end up with. And what you can see here is that 1 day ahead market return predictability is essentially IC is significant, implied the correlation risk premium is significant, and pretty much everything else is also significant here. So when we combine them all together, they all stay relevant as well. And the best regression has pretty much everything in it. And when I say it has everything in it, what I'm saying is that if you look at using ICH and ICL together instead of IC, which is in this regression here, you can see that you've significantly improved the forecasting power. So what we are saying is that instead of using the implied correlation, its two components are better at forecasting the market return 1 day ahead of you. So by itself, IC is the one thing. When we include it with all the IC, all the other variables, it becomes insignificant. But when its components are significant. And so then when we go to the 1 month horizon, the story is the same. The forecast, the R squares are a slightly bigger number, which is good to see. But we can still see that now IC still works when we include it at the 1 month horizon. But when we include ICH and ICL, we see a significant bump in the forecastability. We're going from 4.6% to 10.3%, keeping everything else constant, replacing IC with ICH and ICL. Three-month horizon, same story. But again, individually, ICL or ICH are not better than the IC itself. But when you put them both together, again, there's an improvement in the R squared. And then 6 month horizon, again, the only thing here that's happening is that there's a very marginal improvement from ICL and ICH compared to just using IC by itself. Individually, the individual components are not better than the full thing, but together they improve the predictability a lot. Now, at the 6-month horizon, you see that we are already getting to the point where by itself, IC has an almost 11% predictive power. And what's nice is to see is also that it's much more powerful than things like the variance risk premium, which a lot of people traditionally use for market return predictability. And so overall, we can see, of course, at the 12-month horizon, when we get really, really far out, the same pattern follows. IC by itself is very strong, but ICH and ICL together match it or improve it slightly. So this is the forecasting horizon sort of R squared picture. If you think about horizon on a daily basis, so we're thinking about, I showed you some tables, but you can look at the R squared to see what the pattern is along the time dimension. So this is the R squared from the regressions, and this is the horizon at which we are predicting. And so we've got 4 different R squared series here. And you can see that initially, this is the dash series, the low frequency component is kind of has the lowest R squared by itself compared to the others. But as we go further out, it goes up. ICL and ICH together have the best performance pretty much throughout the horizon. At every horizon, they outperform everything else. ICH is the best performer in the short horizon, and ICL by itself is the best performer in the long horizon. And so the predictive power of ICH starts to fall as we get past 50 days. And then, but ICL picks up around just around that time. It goes from a really small number to start shooting up its R squared. And IC by itself is here in the middle. So it's worse than ICH in the short horizon, better than ICL. And then better than ICL for a pretty long horizon, up to a pretty long horizon, but not better than ICL and ICH combined. So, of course, I mean, just by itself, this is just the option implied information. We want to be able to predict with other variables just to control for things. So we take the Goel and Welch, which is kind of the benchmark in this field, and we run some non-overlapping regressions at different horizons. I'm going to jump over this relatively quickly because even including those controls, so here you can see that initially we have no controls, and then we include the controls. You can see that these variables, they stand their ground, and they are significant depending on the regression. So ICH in the 1-month horizon stays significant and important. ICL is starting to get important, but ICH is still important in the 3-month horizon. And then when we are looking at the 6-month and 12-month horizons, you see that ICL stays in place and significant at the same coefficient as well, size, and the same here with in the 6-month horizon, after including all the control variables of Goel and Welch.
But it would appear here, Jaideep, that the fundamentals are very important, because for the first time we see the adjusted R squared running up to more than 45%.
Absolutely. So basically, what we are talking about here is an incremental improvement from the implied correlation. But of course, the Goel and Welch is kind of the benchmark. The getting that high in R squared is really it depends on that. So that's why we have to include it, and we have to see whether we're still good with including those. But you're right. I mean, like they're very, very important, and in a way that's reassuring, because we want them to be. Otherwise, all our theories are kind of like a little bit off, right? So we have that result here, and despite the very substantial predictive power of these Goel and Welch fundamentals, you've got an improvement in the R squared from IC essentially. And if you think about the IC itself, its predictive power is increasing with the fundamentals from 7.3% at 1 month to 43.9% at the 6-month horizon. And when we think about IC and ICH together, so first we replace IC with ICH. In the short horizon, you've got an immediate improvement, even without the fundamentals, but also with the fundamentals, although the improvement is a little bit weaker with the fundamentals. But the ICL itself, we saw already that it's a poor predictor at short horizons, and it doesn't have any information, in fact, at short horizons. So it's quite useless. But once we get, while we are still controlled for fundamentals, once we get into the longer horizons, ICL becomes more informative and ICH less informative. It's basically the same pattern that we saw without the fundamentals that's repeating with the fundamentals. But including the both of them together is always better than using IC by itself, and better than not using anything at all, right, in terms of just keeping the fundamentals. But the gold standard, I guess, all of these regressions, they're still in sample. Pretty much all this literature does in sample regressions in a sense in this context. So the gold standard would be to think about out of sample forecasting. So if we think about that, then we are looking at an initial 3-year estimation period, and then what we do is we do recursive monthly forecasting. So we keep because in the previous regressions, you can see these are just regressions with the one period ahead information being forecast, but all the data is being used. Here we are literally doing true out of sample, in the sense that we only use the past information to estimate the parameters and then forecast one period ahead. And that's really, really difficult. So so when we do this, I don't want to take up too much more time before we have discussion. So it's kind of like so well known to the people in this room for sure what I'm talking about. So I'm just going to tell you what we are reporting. We report the out of sample R squareds, okay, so which is 1 minus the model mean squared error divided by the the benchmark mean squared error. Mm-hmm. So if this R squared is better than 0, then the model outperforms the benchmark. That's the thing that we need to take away. So let's look at the out of sample R squared predictability. And really, like the one number that's really the most important here in this entire. So, by the way, of course, it's quite well known that it's extremely difficult to beat the historical average, especially in the short horizons, because in the short horizons we just don't have enough predictive power. So the key thing that we achieve here is this number here. The 1 month horizon, we beat the benchmark model with a statistically significant difference. And that's like the key thing. This is a major improvement over everything else. So IC outperforms the historical average benchmark from 1 month to 12 months by itself. Okay, so not always, the 1 month and 12 months. It also outperforms the OLS clearly. So historical average is actually more difficult to beat than the OLS. It doesn't, but individually, ICL doesn't outperform the historical average, the short horizon, but it outperforms in the long horizon, and ICH in the short horizon. But sure, long horizon stuff, ICL is really valuable, and we can see that we are adding some information. But that's great. That's like a lot of other people who've come up with lots of different variables that help. But this bit here is really powerful, because this is something that's really difficult to achieve, that we can see we've got here. And so that's kind of an important takeaway, is that this outer sample R squared is 3.6% and highly significant for ICH at the shortest horizon. And the longer horizons, of course, ICL is much better. So that's basically all I wanted to show you. Using this kind of frequency-based information, we see that implied correlation does have quite a lot of information, and it's horizon specific, and we can extract that and improve market return forecasts. So that's basically my conclusion.
Oh, thank you, Jaideep. This is absolutely interesting, not only for researchers in corporate finance that study the behavior of returns, but also other researchers on forecasting that would try to see how to improve forecasting accuracy, in this case in returns. Remember, in this area, especially in corporate finance, there have been some arguments in the past of the difficulty of forecasting returns, especially for people working in the area of derivatives, where everything moves according to the fundamentals. I think your work is very interesting in paving the way forward, and especially based just on initially good comparison of implied correlations and realized correlations. And then finally, you end up even by looking at some of the, I think at least one, we saw one forecasting accuracy measure in the literature. There are a couple of these, for two or three, but I think the one that you used is okay. Another important aspect, which I liked very much in your work, is try to say we can't forget the role of fundamentals. And you do capture, fundamentals. So if you are looking at, say, stocks, which have more or less the same fundamentals, your time you find a high degree of congruence in the fundamentals, then maybe we can see what if the fundamentals are same, what really explains the forecasting accuracy, say, of returns, because then you rule out, say in a different, you would rule out that the fundamentals would be the big explanation of why returns behave differently. A very exciting work, and thanks for jogging our interest in this particular work. And yes, so what I will do is open the floor for discussion. I see the first question is from Rose. Rosemary is a research fellow here at the Center for Global Finance. Rose.
Yes. I think you briefly mentioned it before about risk aversion. I wanted to know what role does investor risk aversion play in your estimation of the equity premium?
Thank you.
Oh, that's a good question. So I mean, in a way, that kind of connects to what Victor was saying about fundamentals being really important. I mean, in the end, and so we don't necessarily argue that implied correlation by itself is something just kind of mechanical. It does. We do think that it has fundamental information in it, and probably that information is reflecting what investors' expectations are for future correlations, but also not just their, but the risk-adjusted expectations for future correlations, which means that basically what the risk-neutral distribution does is it changes the weight applied to different states of the world, depending on the risk aversion of the participants, so of the market, essentially, or the individuals in the market. So if you find that some states of the world, in the objective prediction of the distribution, so if you just used data about what you believe objectively the future probabilities will be, some states of the world become overweighted, and some states of the world become underweighted in the risk neutral distribution, and that reflects how much people value payoffs in those states of the world. So bad states of the world, for example. So that's where the implied correlation comes in. It's basically extracting that information uh, from the option prices, or rather the range of option prices at different strikes. Does that help answer your question, Rose?
Yes, thank you.
Yeah. Thank you, Rose, and thank you, Jaideep, for the response. Okay, let me look around to see am I missing the hands up, questions, contributions, discussion. Most of the practitioners working in the industry, those who earn their living through forecasting, and could be a number of financial variables, including returns, portfolio performance, for example, the performance of mutual funds, unit trusts, managed funds, sovereign wealth funds, and what you are saying is relevant actually application to all these range of in a portfolio management. They tend to argue, and this is my interaction with some of them, that it is better to do focus over the long horizon. So in this particular case, they would be looking at, say, 10 years, 15 years. Since you have long-term series from, I think what was 1999 to 1996. Yeah, that's about more than 20 years. Do you think that the long horizon matters? My interpretation whenever I get these statements from them is that it is possible anything can happen in the long horizon. Oh, what do you think? Would you feel comfortable forecasting for 3 months ahead so that we are trying to understand what will happen, for example, around July or September of this year, or would you rather forecast what is happening in 2030?
Oh, that's a really challenging question, Victor.
Yeah.
So, I mean, if you think about what this particular type of forecast, so it's a question of what we're forecasting in a sense. Right? So I mean, there's some things we kind of know that they, in the very long run, they sort of converge to the normal distribution. Let's say pretty much everything converges to the normal distribution. Even stock returns, if you aggregate them long enough, you end up with something which is normal, which we would expect from all our statistics rules. But where they will go in terms of high or low, I mean, I think for the long horizon, I would rely more on scenario generation than on individual sort of point forecast. That would be really tricky. And I would try and always combine different variables and forecast them in the long horizon. But for something like the equity premium, the very long horizon, it's very difficult to beat the average. So historical average seems to be, it's even better than the OLS or the autoregressive kind of models or ARIMA models. So that's also true for volatility. It's mean reverting. You go like any model, even the Gauge model, anything. You go 6 months out, it's going to basically give you the mean. So forecasting much further out than maybe a year or two is really very, very difficult, especially using these kind of time series models. I think we would need a different type of model for that. Sorry.
Thank you. That's absolutely helpful. I agree with that observation. Also, given that you are looking at like out of sample forecasts, so you are stepping back, for example, into 2015, and then looking forecasting, and then looking at the values from 2015 to the present. Okay. Jeffrey, I can see another hand from Jeffrey, who is or postdoc research fellow in Stanford Group of Finance. Jeffrey.
Yes, thank you, Jaideep. Sorry, I missed the first 20 minutes of the presentation. I hope I have not, what I'm going to say is going to be in line because of, from where I started, you were talking about the at the point where it switches from perhaps negative to positive. I was wondering whether there's something for linearity. Is there that sort of approach? Would that be value adding to if it stops at some point, then we can maybe look for a different approach to see where that linearity stops, or where something like a threshold or something. Thank you.
So could I just
thank you, Jeffrey, for introducing the variation of a linearity versus non-linearity. Yeah, thank you. Yeah.
So I'm just trying to pick up where it is that you saw that, Jeffrey. So was that in the it was in we were in the tables by then? Jeffrey, could you hear me?
Jeffrey's muted.
Yeah, I think it was somewhere around the first set of tables, because as I was trying to join it, then I just picked that. That was the first set of explanation I got in my head. That there's a switching something going on. There's a point where the prediction or something start to fall. So
yes, I see what you mean. Okay, so where you mean this bit here?
Yes, I think it's somewhere here. I think it must be somewhere here. Yes.
Okay, so in fact, it's basically almost by design that this happens. So if we think about the decomposition, we took 9 parts out of the original series. So we made it into a sum of 9 parts plus an error. And the really, really slow moving bits, we added them up together, the ICL. And the very, very fast moving bits, we separated them out. Basically, if you kept them by themselves, they look like noise almost into the high frequency bit. And so because we have these two things that add up to the full series, we are seeing how much the variation over a longer sort of frequency, a higher frequency, a shorter period, or a lower frequency or a longer horizon, how much each of those two contain information. So we've just extracted information from the time series, and we're just saying that those 2 bits of information pertain as they should to short-term and long-term information in the actual thing that we're trying to forecast. So that's why it's natural that you would find a drop-off where in the beginning, the high frequency thing will do a better job than the low frequency thing, and then the role will reverse as we get further out into the horizon.
Thank you so much thank you. Okay, let me see. I think we still have the hand of Jeffrey, which I think is an old hand. I don't think this is a short question. A second question. How do we go from here? I know for sure that having had the opportunity to talk about the paper and possibly the discussion is going to prepare this paper into a submission, if it's not already under R&R. But okay, so can you point us forward to where this work in terms of avenues for extending this interesting piece of work? Any insights? Yeah.
So I mean, one of the things that that's come up in today's discussion, and that's related to the other paper that I hope to present, was about this particular link about the relation between the implied variables and the fundamentals. And I think that we don't have yet enough sort of analysis of the predictive power of the counterparts, the exact counterparts of these 2 sets of information. And probably, given the fact that if we are trying to look for understanding sort of different risk factors, there's now like a lot of people doing the recent asset pricing papers are using just principal components and of like hundreds of different factors identified in the literature and trying to understand which ones at different times predict predict returns in the cross section or for the market risk premium itself. So it's quite interesting to try and see now what at the individual option level, the firm level, which this is probably the first, or implied correlation is probably the first option implied piece of information that uses the individual firm level information options to try and predict the market risk premium. So to what extent we can sort of exploit more information in that dimension, the individual firm level options, and how many other counterparts we can extract from the option data that we can use for our regular asset pricing or equity so return forecasting exercises. That's still, I think, an open thing. This itself, we want to expand it a little bit. So we're trying to look at using different option sets to see whether that by itself has better forecasting power. So there's like in a way, this option information, model-free extraction of information from options is still there's still some sort of potential there that we could exploit.
And also, I think rightly so, it's an area where further work and further serious extensions would be desirable. I would think that some of our colleagues working in the areas of machine learning, which has its own approach to forecasting, may be already contemplating looking at return predictability, how machine learning is able to dislodge the very entrenched models in finance. So yes, this is a big research program. So I thank you very much, Jaideep, for sharing this work with us. So let me ask colleagues in this seminar to put their hands together and thank Jaideep. Thank you indeed for this interesting work. And you have a hand up, Rosemary.
Yeah, sorry, one last question on the conclusion. What would you say like the implications are of your estimated equity premium for decision-making, investment decision-making, and possibly portfolio management?
So if there's any variable that can improve your forecast of the equity premium, that's kind of really useful for constructing for generally for portfolio management or for asset management in general. But especially if you're thinking about short term, then it basically has hedging implications. And so that's one of the things that you could take out of this is that the series that are already available to us, we just extracted more information from it, and that information is helpful for short-term hedging essentially. So that's one of the things you can take away from it.
Excellent. Thanks. That's a very good question, Rosemary. We always want to know the implications. And thanks, Jaideep, for the response. I'm sure if there are any other practitioners in the audience, this is something like a takeaway from this very important work. So once again, let me thank Jaideep. Let me also thank you, participants, for your time and participating in this seminar. And we look forward to seeing you again in this forum. next
Thank you,
week.
Victor. Thank you everyone for coming, and congratulations, Victor, on your
Thank you.
new role as well.
Thank you.